Yes, we will start with first the disclosure requirement of AS26, which was pending. So let us first finish with the disclosure requirement, the theoretical part. And after that, I think two questions we have to solve. Question number 3 and question number 5. Second question I told you to solve by yourself at home yesterday. I hope you have solved that. Right? So let us first finish off with the disclosure part. And since you can see a huge disclosure requirement, you can technically expect a question direct from the disclosure requirement of AS26. Right? Because you can see so many points to be discussed. And I'll tell you one thing. These are the same disclosure requirements that you also require in AS10. Similar, same. So let us start with disclosure requirement. What they say, the financial statements should disclose the following for each class of intangible asset. When they say each class means for every type of intangible asset, you have to disclose separately. Means if you have patents, then for patents separately, for copyright separately, for purchased goodwill separately, for software separately, right? Then you should also bifurcate between separately acquired intangible asset and self-generated intangible asset. Now, self-generated intangible asset can be in respect of research and development phase. So you have to give a bifurcation of that as well. So what they say, the financial statement should disclose the following for each class of intangible assets, distinguishing between internally generated intangible assets and other intangible assets. So what are the following things we have to discuss? First, the useful life or the amortization rate used. So if you are using the useful life for amortization, then you have to write the useful life. But sometimes you may directly take 1%, 10% WDV or 15% WDV or 20% straight line method as the case may be. So you have to disclose either the life or the percentage used for amortization. Second, the method of amortization should be disclosed. That is whether you are following SLM, WDV, or one more point we learned, proportional depreciation, amortization, that is on the basis of pattern of economic benefit. That is what we learned yesterday. Then gross carrying amount and the accumulated amortization aggregated with the accumulated impairment losses at the beginning and at the end of the period. Sir, it is nothing but opening and closing balance of the intangible asset account and the accumulated amortization account. And I think this same was also required in AS10. You have to give the opening and closing values of the assets as well as the depreciation, accumulated depreciation accounts. So here also the same point arises. Then point number 4, a reconciliation of the carrying amount at the beginning and at the end of the period means with respect to your intangible asset, whatever is the opening carrying amount and closing carrying amount, you have to show the reconciliation. And I think the same reconciliation point had also arisen in AS10. And you have to show the same points for doing reconciliation. Means, for example, if your opening carrying value, now what is carrying value? Sir, carrying value is nothing but cost minus accumulated depreciation minus accumulated impairments. You get the carrying value. So opening carrying value and closing carrying values will technically be not the same. So you have to reconcile and show why there is a difference. So means if the opening carrying value is 100 rupees and closing carrying value is say 150 rupees. So from 100 to 150 it has come. So why it has come? So you reconcile that and show. So because there may be some new additions, there may be some disposals, right? You might have charged some amortizations during the year, or you might have also charged some impairments during the year. So all those things you have to show in the reconciliation. So starting with additions, indicating separately from those from internal development and to amalgamation. Means if you have added some new intangible assets in your enterprise, then you have to indicate them separately if it is through internal development, that is self-generated, or if it is from amalgamation, that is any intangible asset arising because of amalgamation, then they have to be disclosed separately in the reconciliation also. But if you are separately acquiring it, no problem. Retirements and disposals means whatever intangible assets are eliminated from the balance sheet, that will be considered in the reconciliation. Impairment losses recognized in the profit and loss account, as well as impairment losses reversed in the statement of profit and loss account. So impairment losses, if you have charged, so definitely the value of the asset has reduced. So it will also be shown in the reconciliation. So how the reconciliation generally can be made? See, if you are at 100 and you want to reach to 150, right? So what else do? Sir, we did addition of 70, new asset coming in of 70, so plus 70. Sir, we charged minus 10 rupees amortization. Sir, we charged minus 10 rupees impairment, right? So can I say you reach to 150? So this is how you have to reconcile and show in simple terms. So these all items are possible. Additions, retirement disposals, impairment losses recognized, impairment losses reversed, and amortizations charged during the year, and any other changes in the carrying amount. Any other changes means if you have done a revaluation, because generally on intangibles we don't do revaluations, but it is possible you can do revaluations on the intangibles as well. Then lastly, if an intangible asset is amortized for a period greater than 10 years, then you have to give the justification of why the life is greater than 10 years. That is what the last and the final disclosure is all about. Now, what they say, if an intangible asset is amortized over more than 10 years, the reason why it is presumed that the useful life of an asset will exceed 10 years from the date when the asset is available for use. In giving these reasons, enterprise should describe the factor that played a significant role in determining the useful life of the asset. So on what grounds or on what basis you say that the life is greater than 10 years is what you have to disclose in the notes to accounts. So these are basically the disclosure requirements with respect to AS 26. And you can expect a full-fledged direct 5-mark question out of this. Like what are the disclosure requirements of AS 26 for 5 marks? And I think majority of the points are from AS 10 itself. See, life and amortization rate, there it was life of the asset or depre rate, method of depreciation. For third point also was same, opening and closing balances of the asset account and accumulated depre account. Then reconciliation. Only in reconciliation, there were some 3-4 points extra with respect to revaluations also. Here, those revaluation points are not there because generally on intangibles, we don't charge revaluations. But rest all points are same. Additions, retirement disposal, impairments charged, impairments reversed, amortizations charged, any other changes. So technically, if you by heart the AS 10 disclosure requirement, your AS 26 disclosure requirement is complement. And even if I talk about the topic AS 26, the definition of intangible asset, right, and the measurement of cost in that you learned with respect to amalgamation and research development cost, right? And I think these are the only 3 items which were different, and one of the method with respect to amortization, that is on the basis of pattern of economic benefit. So technically, apart from these 3 or 4 concepts, the entire topic was same. Correct? So let us go ahead now. Anybody with any sort of query with disclosure point? If yes, then you can raise. If not, we'll go ahead for the questions, the pending questions of the topic. Fine. Nobody is raising any queries, so it seems it's clear. So we go for the questions now. Yes, I will be first starting with question number 5. I will first be starting with question number 5. Now, what it says, it's a very, very good question. It's a beautiful question. And this had come in exam, and it's very logical also. It's very logical question. And let's see how many of you are able to crack this point. Now, what they say, Plymouth Limited is engaged in research on a new process design for its products. So it is engaging in some research. It had incurred 10 lakh rupees on research during the first 5 months of the financial year 12-13. Now, sir, we yesterday only learned that if an enterprise is incurring any expense on the research part, the entire amount will be charged to the profit and loss account immediately in the financial year in which it is charged. Incurred. So it is incurred in 12-13. So technically in 12-13, entire 10 lakhs goes to profit and loss account. Okay. The development of the process began on 1st September 2012 and up to 31st March 2013. That is over a period of, I think, 7 to 8 months. A sum of rupees 8 lakhs was incurred as development phase expenditure, which meets the asset recognition criteria. So 8 lakh was incurred on development, which is meeting the asset recognition criteria, means technically entire 8 lakh can be capitalized as an intangible asset because it meets the asset recognition criteria in the balance sheet. Correct? Further, from 1st April 2003, that is on 31st March 2013, the asset met the recognition criteria. So technically, we can record the asset on 31st March 2013 in the balance sheet. But what they say from 1st April 2013, that is from next year, the company has implemented the new process design, and it is likely that this will result in after-tax saving of 2 lakh rupees per annum for the next 5 years. So company will start to use from 1st April 2013 the process design which it has developed internally. And with the help of this new process design that they are going to use, they say that company will have an after-tax saving of 2 lakh rupees per annum for the next 5 years. So, sir, one thing I can conclude from here, the life of the asset is 5 years. The life of intangible asset is 5 years because company is able to use it for the next 5 years and earn a savings of 2 lakhs after tax. So it's a benefit for the company. Means economic benefit is given. Yes or no? And can I say the economic benefit is equal every year? So if amortization is to be done on this asset, it will be done on SLM basis strictly in 5 years. Correct? I hope this point is clear to people. Okay. The cost of capital is 10%. Means company's cost of capital. The cost at which company raises capital from the market is 10%, which is nothing but in short IRR of the company. That is internal rate of return of the company is 10%. And the present value annuity factor of 1 rupee for 5 years at 10% is 3.7908. So they have given you the cumulative discounting factor of 5 years at 10%. Cumulative factor 1, 2, 3, 4, 5. All 5 years added together. Decide the treatment of R&D cost of the project as per AS 26. Now, sir, research, no problem. Research cost 10 lakhs debit to P&L. But, sir, what is to be done with respect to development cost? Sir, it is very simple now, sir. 8 lakh rupees development cost is given. So it has to be directly capitalized in the balance sheet as an intangible asset. That is simple. Okay. But then why all these other data is given? Why they have given you that the company is going to implement from 1st April 2013 and over a period of 5 years, company will earn 2 lakh rupees benefit over a period of 5 years. Then present value factors are given. What is the logic behind giving all these things? Sir, please understand. This is a question based on impairments. This is a question based on impairment. But sir, for calculating the impairment loss, we also require the fair value of an asset. Because I know the book value of the asset is nothing but the cost of the asset 8 lakh because it is a fresh new asset. So book value and cost will be same 8 lakh. But where is the fair value? Sir, the data given in the question will be used to calculate the fair value. This is also a way to calculate. Yes. If the fair value is not available from the market, an enterprise can always calculate the fair value of the asset based on the present value of all its future expected cash flows. So if if an intangible asset can generate 2 lakh rupees savings to the company, means technically that is the cash flow of the asset for a period of 5 years. So you have to take the present value of the 2 lakh for 5 years. And that present value will be considered as the fair value of the asset, which you will compare with 8 lakh rupees. If fair value is less, book value is greater. So technically, you cannot record your asset at 8 lakh. You have to record your asset at the fair value only, and the difference between book value and fair value will be impairment loss. Will be impairment loss, which will be recognized today only, but in the form of amortization itself. Right? And technically, we will start amortizing the asset from the next year over a period of 5 years, because the asset is available to use from 1st April. But sir, in this year, how you are charging amortization? Sir, this year, I am not charging amortization because of using the asset. I am charging amortization because of impairment loss. So it can also be shown as an impairment loss. If you want, we can write it in the bracket. The loss of rupees, whatever is coming, will be amortized in the correct year. Now, amortized means what? Writing off the asset. So you are writing off in the form of what? Impairment. Right? So has anybody calculated what will be the present value? You just have to multiply 2 lakh with 3.790. Somebody is giving the answer 7,58,160. Sir, this is the fair value. So there will be a loss of rupees 41,840. So technically, your asset should be recorded in the books at 7,58,160, not at 8 lakh. But I have spent 8 lakh, no problem. The difference 41,840 debit P&L immediately in the current year only. That is as on 31st March 2013 itself. See, even I have written a statement over here and I'm expecting others to copy this statement. What the statement says: fair value of an asset is generally the value available in market, but fair value can also be equal to the present value of all expected cash flows from the use of asset. So when you use asset, you will have cash flows with you, and present value of all those cash flows can also be treated as the fair value of the asset. But generally, fair value you can get it from the market, but here that data is not given, but other data is given which can also be used for calculating the fair values. So I hope you are understanding the question. And this had come in exam. So you have to divide your answer into 2 parts. First, for research part, you have to write, and then for development part. So please note down this point in your question or in your notebook anywhere which is comfortable for you. Please write down this point. Yes, Anshul.
So how we should identify this question is related to impairment losses, sir?
Sir, data is given, sir, everything. All the data is given, and I have told you now how to calculate the fair value of the asset.
Yeah, sir, that.
Right. So when you get these data, when you get the cash flows, and when you get the discounting factors and all, and they are asking you at what value the intangible asset should be shown. So you have to understand that, sir, since all these data is given, I have to calculate the fair value of the asset by working out the present value of all the cash flows.
Okay. So the development cost of rupees 8 lakh rupees, if nothing was given, you have to amortize it over a period of years.
If nothing is, if other data is not given, then my answer would have been very simple, that capitalize the asset at 8 lakh in the books. And from next year onwards, that is 1st April 2013 onwards, we can charge amortization. See, in current financial year 12-13, amortization cannot be done.
So amort and depreciation are same, right, sir?
Almost same, but on the fixed asset, amortization on the intangible asset. That is the only difference.
Okay.
But both are same, writing of the cost of the asset over its useful life.
Okay.
Right. So let us go for the solution now. Question number 5. First, we will write about the research expenditure, and then we will talk about the development expense, which is called as cost of internally generated asset. So for research, what they say, According to AS26, the expenditure on research of new process design for its product rupees 10 lakhs should be charged to P&L account in the year in which it is incurred. It is presumed that the entire expenditure is incurred in the financial year 12-13 only. Hence, it should be written off as an expense in that year itself. So research cost, nothing to be worried about. Directly, you can answer that it has to be written off in the P&L account. But now starts cost of internally generated asset, that is with respect to development phase. Now what they say, it is given that development phase expenditure is amounting to rupees 8 lakh was incurred up to 31st March 2013, which meets the asset recognition criteria. So as per AS26, for measurement of such internally generated intangible asset, fair value should be estimated by discounting the estimated future net cash flows. And one more point I would say, the concept of calculating the fair value, what you have learned now, can be used for any asset. Can be used for any asset. It can be used for internally generated tangible, intangible, any asset. So generally, if you have the fair values available, no problem. If fair values are not available, but you have the estimated future cash flows associated with that particular item of asset, then you can calculate fair value on this basis. You can do it for any asset. It is not restricted only to intangible asset which are internally developed. No, even for a separately acquired asset, you can calculate the fair value. Means the logic is what of calculating fair value means, sir, with the use of this asset, you are going to earn on present value basis only 7,58,000. So when you are going to get the benefit of only 758, right, over a period of 5 years, then why do you want to record your asset at 8 lakh? You record your asset at 758 only, na? Means technically what cost you have incurred for acquiring the asset, less than that is your benefit. So today only you write off that difference amount as impairment. That is the logic of this type of fair value. So it is given that development phase expenditure amounting to 8 lakh incurred up to 31st March 2013 meets the asset recognition criteria. As per AS26, for measurement of such internally generated intangible asset, fair value should be estimated by discounting the estimated future net cash flows. So all the data is given. Savings after tax per annum for next 5 years, 2 lakh rupees per annum. Company's cost of capital is 10%, and the annuity factor cumulative discounting rate at 10% for 5 years is also given in the question at 3.7908. So present value of net cash flows will be nothing but 2 lakhs multiplied by 3.7908. So total value is 7,58,200. So the cost of internally generated intangible asset would be lower of cost value 8 lakh or present value of future net cash flows, that can also be called as fair value, 7,58,200, whichever is lower. So technically this is lower. So we have to record it 7,58,200. Hence, cost of internally generated intangible asset will be 7,58,200. The difference of 41,800 rupees will be amortized by Plymouth for the year 12-13 itself in form of impairment loss. So this 41,800 will be subtracted from the cost of intangible asset and debited to P&L in the form of an impairment loss. And lastly, the third part, that is amortization on the asset. So it's very simple, sir. The company can amortize 7,58,200 over a period of 5 years by charging rupees 1,51,600 per annum from the financial year 13-14. Because the pattern of benefit is equal for all the 5 years, so company can technically follow straight line method. So directly 7,58,200 divided by 5. So this is how you will be charging the amortization. So this is your full-fledged solution. Anybody with any sort of query with this question? Question number 3 of this chapter is exactly same as question number 5. Same question. Same to same. Yes, Vishal.
Good evening, sir. A bit
Good
of a
evening.
general question, sir.
Huh?
Now here the difference between 8 and 7.5 lakhs is not significant. Supposing if the
Huh?
cash flows were only 3 lakh or 4 lakh, so
Huh?
if the company decides it's not worth writing off 4 lakh, if the company decides it's not worth capitalizing the asset, can it recognize the entire research and development cost in P&L itself so that maybe it can help in tax planning or something like that? Is it
So
allowed, sir?
technically, see, you can do it, but it is not allowed because asset has met the recognition criteria.
Can
Then you
they
have to
show it in such a
manipulate.
way that even the development
Ah.
that amounts to manipulation?
Yeah, you have to do some manipulation and say that it does not meet recognition criteria and should write off immediately.
Okay, sir.
So
Okay.
that is your internal manipulations. So that you have to do, and you should not even let your auditors know about this. You have done such manipulations.
Okay, sir. Thank you.
So your scientist should write and give that development is also failed,
Okay, sir. Thank you.
right? If you have read question number 3, it is exactly cut, copy, paste as question number 5. Same to same, no change. I'll just read the question for you. It is exactly the same. NDA Corporation is engaged in research on new process design for its product. It had incurred expenditure of 530 lakhs on research up to 31st March 2010. So technically, entire research cost of 530 lakhs will be written off in the profit and loss account as on 31st March 2010 itself. That is in the financial year 9-10. The development of the process began on 1st April 2010. So we started development from the next year, and development phase expenditure totaled to 360 lakhs up to 31st March 2011, which has met the asset recognition criteria, similar to the earlier question. From 1st April 2011, the company will implement the new process design, which will result in after tax saving of 80 lakh rupees per annum for the next 5 years. Cost of capital 10%, and they have also given you the discounting factor. 3 things they are asking, same as the previous question. What should you do for research expense? What should be the cost of internally generated asset? And what should be the amount of amortizations to be charged on the asset for 5 years? So can I say exactly same question? Right? Book value is 360. So what will be fair value? Fair value is 303.264. 303.264. So 360 minus 303.264, 56.736 lakh is your impairment loss. Correct? So asset will be recorded at 3,03,000. So how much amortization will be charged? So it is 3,03,264 divided by 5 years. 3,03,000.264 divided by 5 years. So technically 60.65 lakhs amortization we have to charge for 5 years. It is exactly the same question. Correct? Even the solution is also same, presented in the same manner. So you can just, if anybody is not having the solution with them, you can just take the screenshot of the solution if you don't have it. One change I have made in the solution that you can see. Earlier, I think wrongly, I had written financial year 10-11 in the solution that you people have. Today, I changed it. It should be actually written off in financial year 9-10 only. That is, as on 31st March 2010 only, it should be written off. So this is the only change. Rest all the solution remains the same. No change. Same to same. Research cost same. Same way it is presented for internally generated asset. We calculated the cash flows also. Right? And amortization also same, 60.65. So this is exactly cut, copy, paste as question number 5. Correct? So if anybody is not having the solution, please take a screenshot of the same. but I think I've already given you the PDF file, so you have the what we say, the solution, right? I'll take you to a very, very good question. That is the reason why I'm not going in detail of question number 3, because it is exactly same as question number 5. But I want you people to please open up page number 154. We have to do this question, homework question of question number 5 from your material. It's a beautiful question. And I want to spend some time on this question rather than wasting time on question number 3, because it's exactly similar to question 5. So please come to question number 5 on page number 154. Shall we start? Have people reached page number 154, question number 5? Okay. Very, very nice question. Messrs Mahesh Limited is developing a new production process. During the financial year ended 31st March 2013, the total expenditure incurred on the process was 60 lakh rupees. The production process met the criteria for recognition as an intangible asset on 1st December 2012. Expenditure incurred till this date was 32 lakhs. Sir, we started the process from the beginning of the year, from 1st April 2012. But we finally gained some achievements from 1st December 2012 when the asset met the recognition criteria. Until this date, 1st December 2012, company had spent 32 lakhs. But overall for the full year, company has spent total 60 lakhs. So technically, as on 31st March 2013, the intangible asset in the books should be shown at what value? 60 lakh or 32 lakh, or the difference between the two, 28 lakh. I got one answer as 28 lakh. 32. Niranjana gives 32. 28. 28. Now, if you remember my yesterday's point, I clearly said that the date when the asset reaches or asset meets the recognition criteria, from that day the cost should be capitalized. So technically the asset met the criteria on 1st December. So from 1st December onwards, whatever cost we are incurring, that should be capitalized. Right? And the question says that till this date, we incurred 32. So technically, after this date, we have incurred how much? 28 lakh. Because totally 60 lakhs, right? So 60 minus 32, 28 lakh capitalize on 31st March 2013. And sir, this 32 lakh will be debit to PL, and this can be very much considered as the research cost also. Or else, if you consider this as development cost, no problem, sir. But logic is what? Development cost incurred prior to asset meeting the recognition criteria also goes to P&L account. So end of the day, this 32 lakh has to be debited to P&L account as on 31st March 2000. This looks like 70. Correct? Debit to P&L account. Shall I read the question further? Further expenditure incurred on the process for the financial year 31st March 2014 was 90 lakhs. Means the development is still continued. Right? And next year we total spended 90 lakh rupees more. And this is not a subsequent expenditure. Huh? The process is still continued. Process is not yet completed. So some students feel that, sir, this should be subsequent cost. No, it is not subsequent cost. Up to last year, 28 lakh incurred, and still the process is going on. And in current year, we incurred 90. So total 90 plus 28, 118 lakh should be the cost of the asset. Yes or no? Correct. But what they are saying, as on 31st March 2014, the recoverable account nahi hai, it is amount hona chahiye. It has to be amount. The recoverable amount of know-how embodied in the process is estimated only to be 82 lakhs. The recoverable amount is, can I say, fair value? Means it is recoverable from the market only at 82 lakhs, right? This includes estimate of future cash outflows and inflows. So technically, they have, I think, calculated 82 lakhs on the basis of estimated future cash flows and inflows. Means they have used the same earlier technique only. But no problem, they've already calculated and given us. So technically, should I show the asset at 28 plus 90? So 118 is the book value, correct? And 82 is the fair value. So I should be recording the asset at fair value 82, and the difference 36 lakh loss. Which loss? Impairment. Correct? It will be impairment loss. I hope you are understanding the point. Anybody who has not understood this point? You are required to work out what? First, what is the expenditure to be charged to P&L account as on 31st March 2013? Sir, 32 lakhs we already calculated. As on 31st March 2013, that is first year, 32 lakh will be debited to P&L. Correct? What is the carrying amount of the intangible asset as on 31st March 2013? So in the first year, intangible asset will be recorded at 28 lakh, capitalized on 31st March 2013. Correct? So two answers we are given. Third question, what is the expenditure to be charged to profit and loss account for the year ended 31st March 2014? Sir, 36 lakh of impairment loss is what we have to charge to the P&L account. Correct? And what is the carrying amount of the intangible asset as on 31st March 2014? So it should be 82 lakhs fair value. Right? It's a good question. So let us see the solution, how they are providing it. This is the solution from here. So as per AS 26, intangible asset, point number 1. Expenditure to be charged to the P&L account for the year ending 31st March 2013, 32 lakhs is recognized as an expense because the recognition criteria were not met until 31st December 2012. This expenditure will not form part of cost of production process recognized as an intangible asset in the balance sheet. So this will not go in balance sheet. This will go directly to P&L. Balance 28,000 will go to balance sheet. Carrying value of intangible asset as on 31st March. So at the end of financial year on 31st March 2013, the production process will be recognized as an intangible asset at a cost of 28 lakh. That is 60 minus 32 lakhs. Expenditure incurred since the date the recognition criteria were met, that is from 1st December. So no need to write this bracket, not required. Right? Then third point, what is the impairment loss to be debited to P&L? So you have shown the proper calculation. The carrying amount, that is nothing but opening balance is 28 lakhs plus expenditure incurred in the current year is 90 lakhs. So total book value should be 118. But recoverable amount is only 82 lakhs. So 118 minus 82, 36 lakh will be impairment loss. So 36 lakh will be charged to P&L account for the year ending 31st March 2014. Correct? And lastly, the carrying value of the intangible asset on 31st March. So what will be carrying amount? 118 minus 36, 82 lakh will be the carrying amount, which is nothing but the fair value of this. So book value minus impairment loss, that is equal to carrying amount. So 118 minus 36 equal to 82 lakhs. That is the book value of the asset on 31st of March 2014. Yes, Anshul.
So just a clarification. If there was a subsequent cost, sir, it would be added to the cost of the capital, right, sir?
Sir, but subsequent cost is incurred when the asset has been recognized in the books. After that, it is incurred. And subsequent cost can be capitalized. There are some conditions.
Yeah, sir,
It
two
should
conditions, sir.
increase the earning capacity. It should increase the earning capacity of the intangible asset, and the cost can be measured reliably.
Okay. So if in the question it is provided that so as on 1st December 12, the recognition criteria is met, right, sir? So the asset can be recognized in the balance sheet as on 1st December 12. So after that, any expenditure taken place relating to the subsequent.
Sir, you did not understand the question. The development on 1st December met the criteria, but development work is still on. You started the process from 1st April, but you're not getting the satisfactory results. So finally, you got some satisfactory results on 1st December, where you can say that, yes, now I have developed something which can be converted into a final finished product as an intangible asset. So on 1st December, you meet the recognition criteria. So from 1st December onwards, whatever cost you are incurring on the development can be recorded as the intangible asset. So from 1st December 2012 to 31st March 2014, total 118 lakhs, that is what you have incurred on the development process. That entire becomes the cost of intangible asset. Assuming on 31st March 2014, development is over. And if some further development is still continuing, means it is not yet completed, then technically, I think it is completed because you have recorded an impairment also. So it is completed as on 31st March itself.
Okay, sir.
But if it is still not completed, then next year also whatever cost you are incurring will be added.
So my question is that if as on 31st March 13 only the work is completed, development work, and later on they make a subsequent expenditure, sir, then we'll add to the cost of the asset, right, sir? If
that satisfied the conditions, it will be added to the cost of the asset.
Okay, sir. Thank you, sir.
Yes, Naman.
Yeah, sir, I have a doubt that in case if the cash inflows increases in the next year, like increases from 82 to 100 lakhs, so we will be debiting asset account and P&L account. Asset account to P&L account.
Correct. Reverse impairment. That is allowed. You can do that.
Thanks, sir.
Right? Anybody else with any query with this topic? Because technically I am concluding AS26. If anybody wants to raise any query with AS26, please ask it. After that, we'll be starting with next topic. Question 2, I already said as a homework. Anshul, I think you were there or not, I don't know yesterday. I've already said that as a homework. And I also solved the question roughly yesterday only. See. I solved the question yesterday only roughly. And I told you to put it in fair. It is on the basis of pattern of economic benefit, you have to charge the amortizations. That's it. Even the solution is printed in the material. See, this is how you have to present. And I told you, don't show from year 4 to 10 separately. You can directly write 4-10 years per annum. Because end of the day, it is going to be 24 rupees per annum for all the balance 7 years. So why to calculate it for 7 times? Do it only for once. That is also I told yesterday. Correct? If anybody is not having question number 2 solution, you can take a screenshot of the same as well. Anybody else with any other query with this topic, or shall we put a full stop to this now? Yes, Harshit.
Sir, just a clarification, sir. Sir, when the asset will, after the development phase, sir, the amortization should be, we start from next year, no, sir?
Yes, from 1st April 2014, we will start amortization.
Okay, sir. If it is in research phase, then only...
data is not there. In the question, data of amortization is not there. That is why we did not speak anything about amortization.
Okay, sir. But if it is in research phase, then whole amount should be transferred to P&L.
Transfer to P&L. Yes, yes, yes. Because research phase cannot be ever capitalized. Even if you are developing an intangible asset which meets the asset recognition criteria in the research phase itself, still it has to be debited to P&L.
Okay, sir.
Because institute considers research as a normal recurring expense. Because any enterprise continuously go on doing research and research and research. So it is always to be debited to the P&L.
Okay, sir. Thank you.
Right? So we'll stop the recording over here. Okay.